Today we will learn about stock market basics, and it's simpler than you think. Before we get into the video, make sure to subscribe to the channel and leave a comment below saying I subscribed, and we will try our best to personally reply to your comment. The stock trading information that is being broadcast by the media can seem like nonsense if you are unfamiliar with the fundamentals of the stock market. The average investor doesn't pay much attention to terms like earnings movers and intraday highs, and in many situations they shouldn't. You don't need to be concerned about the meaning of these phrases or the flashes of red or green that cross the bottom of your TV screen if you're in it for the long haul, such as with a portfolio of mutual funds targeted toward retirement. Without having much of a stock market expertise, you can manage just well. If, on the other hand, you want to learn how to trade stocks, you do need to understand the stock market, and at least some basic information about how stock trading works. Exchanges like the Nasdaq and the New York Stock Exchange make up the stock market. Stocks are listed on a particular exchange, which serves as a market for the shares of those stocks and connects buyers and sellers. The exchange keeps track of each stock's supply, demand, and price in addition to other pertinent information. 1. Understanding the stock market. People typically refer to one of the key market indexes when they talk about the stock market being up or down. A market index measures the performance of a collection of stocks that either fully or partially reflect the market, such as technology or retail enterprises. The S&P 500, Nasdaq Composite, and Dow Jones Industrial Average are likely to come up the most because they are frequently regarded as proxy for the performance of the entire market. Indexes are used by investors as a benchmark for the performance of their own portfolios and, in some situations, as guidance while trading stocks. Through an index fund or exchange-traded fund, or ETF, which often tracks a particular index or sector of the market, you can also invest in an entire index. 2. Stock trading information. Even the most seasoned investors can become uneasy due to record high inflation and stock market volatility brought on by conflict, supply chain problems, and rising interest rates. Additionally, the majority of investors would be wise to create a diversified portfolio of equities or stock index funds and keep onto it during good and bad economic times. However, investors that prefer a little bit more movement trade stocks. In order to pace the market, stock trading includes continuously purchasing and selling equities. Stock traders want to profit from short-term market changes so they can sell their stocks for a profit or purchase them at a bargain. Some stock traders buy and sell multiple times throughout the day, which is known as day trading. Others are merely aggressive traders who execute a dozen trades or more each month. Investors who trade stocks conduct in-depth study and may spend hours each day monitoring the market. To uncover trading opportunities and patterns, they rely on technical stock research, using tools to chart a stock's movements. 3. Bull markets versus bear markets. Neither is an animal you'd want to run into on a hike, but the market has picked the bear as the true symbol of fear. A bear market means stock prices are falling, thresholds vary, but generally to the tune of 20% or more, across several of the indexes referenced earlier. Bull markets are followed by bear markets, and vice versa, with both often signaling the start of larger economic patterns. In other words, a bull market typically means investors are confident, which indicates economic growth. A bear market shows investors are pulling back, indicating the economy may do so as well. The good news is that the average bull market lasts much longer than the average bad market, allowing you to grow your money by investing in equities over the long term. On June 13, 2022, the S&P 500, which represents roughly 500 of the major equities in the United States, entered a bear market. Although it has slightly recovered, it is still down more than 15% from a year ago. But when you take into account reinvested dividends and account for inflation, the index has historically returned an average of around 7% every year. Therefore, if you had invested $1,000 30 years ago, you would currently have around $7,600. 4. Stock market crash versus correction. When the stock market falls by 10% or more, a correction has occurred. A stock market collapse is a sudden, significant decline in stock values, like the one that occurred in early 2020, just before the COVID-19 epidemic started. Even while crashes can signal the beginning of a bear market, keep in mind that bull markets typically outlast bear markets, meaning that stock markets tend to appreciate over time. By August of 2020, the market had returned to setting new records. Keeping your eyes on the big picture will help you calm your crash-related fears. It might be frustrating to watch the value of your portfolio drop in real time during a stock market downturn while taking no action. But if you're investing for the long run, staying put is frequently the smartest move. Why? Because you lock in your losses when you sell investments during a slump. You will almost definitely have to pay more for the privilege and give up some of the gains from the comeback if you want to re-enter the market at a more favorable time. Before we get into the last one, make sure to subscribe to the channel if you want to become rich. 5. The importance of diversification. As an investor, you cannot avoid bear markets. The danger that comes with an under-diversified portfolio is something you can prevent. Your portfolio is better protected from inescapable market declines when it is diversified. If you put all of your resources into one business, you're gambling on success that could be effectively ended by regulatory problems or poor management. Investors diversified by combining several stock kinds, balancing out the inevitable losses, and removing the possibility that one company's tainted meat may devastate your entire portfolio in order to smooth out that company's specific risk. However, it takes a lot of work, perseverance, and research to put together a diverse portfolio of individual equities. A mutual fund, the aforementioned exchange-traded fund, or an index fund are other options. Since they own a variety of investments, you are already diversified. Bonus. The bottom line: nothing takes the place of exhaustive research. However, one key way to protect your assets is to invest for the longer term by taking advantage of dividends and finding stocks with a proven record of success. Unless you have the time, risky and aggressive trading strategies should be avoided or minimized. Thank you for watching. Don't forget to subscribe to the channel.